So, what we're going to talk about it today is probably, let me see. Okay, we'll talk about from the opportunity to a business plan, and it's in the chapter 10. And just give me a second here. Okay, and here we go. So basically, we'll be talking about more how you find about financial plan and how you do your pre forma and how you get the loan and how you get financial needs and how you do the calculation for that. The financial plan provides a complete picture of how much and when funds enter the organization. So you have a company, you're newly established, a financial plan will tell you how much money is coming in and how much is exiting from that. Where the funds are going, how much cash is available on hand, and the projected financial position of the firm. As I said in the early classes, we talked about the lots of companies, they have a short in cash because they don't do, a proper financial planning. The financial plan provides a short-term base for budgeting and prevent uh, a common problem like a lack of cash. So they explain how the entrepreneur will meet the obligation and maintain the liquidity, because lack of cash could be one of the major things that an entrepreneur will be stopping his business. In general, the plan will need a 3 years of projected financial uh, data for the outside investor. So anybody who wants to invest in your entrepreneurship venture, he needs to see the next 3 years at least how far you're going to get with your business plan. Now, before developing the pre-forma income statement, prepare the operating and capital budget. So you need to develop your operating and capital budget. If you are a sole proprietorship, then you have to do responsible for all the budgeting decision. If you have a partners, you might have your partners or the employees is doing that for you. A sales budget must be developed because they want to see how much sales you're going to make, and it's supposed to be on a monthly basis because some month we will have a high peak um, on sales, and some month will be a low seasonal. It could be a very much a seasonal thing, and you need to do a monthly a budget for it, and you need to determine the cost of these sales. Now, include and when you determine the cost of the sales, then you can really come up with a strategy of how you're gonna mark up your products and how to make it profitable. Um, Include an ending inventory to buffer against the demand fluctuation. You also need to tell the investors and tell yourself how much you have in your inventories, because an entrepreneur, when it runs out of the product or the service, then you will lose customers there. A production budget allows a projected cash flow for the cost of the good produced, including the inventories. This provides an actual production need each month to meet the demand. It determines how much is spent and for what purpose. When you do such things, what will happen to you is basically you will be able to really do a projection of coming demand, and you're not going to run short, cash wise or product wise in the inventories. Now, in the operating and budget and capital budget for operating costs, uh, uh, you need to list the fixed expenses, and we will talk about what's a fixed expenses, what's a variable expenses, uh, which vary the sales and marketing. So fixed expenses is equipment that you need to buy, something that you need to spend over 1 year. The variable is usually less than a year, which is, it could be a variable cost, uh, cost of selling and cost of it. These are all has to be budgeted within your operation. The capital budget are used for evaluating the expenditure that may impact the business for more than 1 year. So you need to, buy new equipment, vehicle, computers, or whatever new facilities, and they consider to be part of, if they last more than 1 year, it would be part of their capital budget. And they are fixed costs. You need, in that time when you start a business, you might want to rent most of these things, minimize your, fixed cost expenses. You can lease them or, rent them. Now, forecasting sales, there are many methods for you doing a projecting sales. But you want to make sure when you do a forecasting for sales, you want to, you know, um, uh, put the fluctuation there, chance of a 10% more sales or chance of 10% less sale, and the effect of it. The projected sales simply a reasonable using a quantitative method. Well, how many sales, how many units you will be selling, and what's the revenue, what's the cost of that, so you can do your pro forma budgeting and financial statement. So you can start up in the same industry that can, but how you can get it is you can check with your competition or the industry that they do the same thing. You can check with the local chambers, or you can do estimating, but you want to make sure that you you have a high and end and a bottom of your sales. So if you're selling 10 units, you're going to take into consideration 12 units and take it into consideration 8 units. So this way you stay in a safe side because your variable costs depend on it. So this way you can do the pro forma income statement, require monthly projection, because they want to see how much you're going to make an income monthly and how much they need to invest as an investor in your business, and to see whether they have to increase on time investment or reduce the investment, or whether your sales and your profit generation at what time is going to be sustainable, and you don't need them to to invest in you. So first, you calculate the sales by month when preparing the pro forma income statement. And then you do the cost of the sales, can be disproportionately higher in some month, as we said, and lower in some month because of the sales goes up and down. The sales revenue, usually if you have something you want to sell it on the internet, it's very difficult to estimate it, but you can roughly estimate that. But the good part of this part is the fact once you get the customer, you want to make sure that you serve the your customers first, and then you serve your potential customers. Now, the pro forma income statement provide a projection of operating expenses for each month. So once you do the sales, once you do the marketing expenses, the sales, which is revenue, and then you put the marketing expenses and the sales expenses and the cost of the goods sold, and then you can really start generating a kind of a statement that understandable for the investors if they have to invest in it. Um, so these are the issues that you need to look at it. Investors prefer, as we said, 2 to 3 years a projection, a plan. Um, as you know, some expenses remain stable. Otherwise, use year one as a guide. If the expenses is not stable and you cannot predict it, you always can use and there is no independent variable involved in it, you use the first year expenses. So let's say you buying something and it has a 10 years old, 10 years, you can use, the previous year. And when you do be conservative when you're projecting operating expenses, because the investor do not want to see so much expenses, because that means they have to, calculate expenses versus the the revenue they might generate from it and when they can generate that revenue from it. Um, Now, cash flow is one of the main crucial things that you need to look at it and maintain it in a positive way. You see, the cash flow is not as same as a profit. Sometimes you are very profitable organization, you have very profitable venture, but in the same time, you don't have enough cash flow. And that might cause, a bankruptcy or because not to expand on your business. So you need to be positive in a cash flow, more important than first in the first few years, than be a profitable. Depreciation is you consider it to be as an expense. I'm sorry, part of it. Reducing a profit, not a cash outlay. So to do, there's two things that you can do to increase your cash flow. One is a direct and indirect. The indirect, the method adjusts the net income for cash, not yet in or out. The second, the direct method is simply determining the cash in and less cash out. See, this is two type of you can use in estimating your cash flow, cash in, cash out, how much cash is coming in, how much cash is going out. And the second way is the indirect method, which is adjust your net income for the cash not yet in. So your net income, if the cash doesn't come in your pocket and with the customer, it's not part of your income. This is one way. And the other way is how much you have money coming in and how much money you're leaving. So a monthly projection of a cash is a pro forma of cash flow. When the outflow is greater than inflow, then you need to secure more cash. Invest large short-term sources of positive cash flow. Negative cash flow are likely for a new venture, so estimate the conservative to cover the negative month. So if you need more cash, you need to estimate how much and where you can get it. And do a revised projection and provide the scenarios based on the different sales of level. As I said, when you do a sales projection of sales, you need to see maybe there is more or less, and then you need to see if you have a extra cash this month because you sold more. Maybe next month you will have less cash coming in, so you need to save this month cash for the next month that you need. This is one of the way of doing it instead of borrowing money. Now, as we said, when accounting part of it is very important, and the pro forma, the balance sheet is reflect the company position. Um, Basically, at the end of the year, there is what do you call assets represent everything of. This is how you do the financial statement or the pro forma balance sheet. There is three parts in the balance sheet. There is a part which is called assets. The second one is liabilities, and the third one is the owner equity. And the assets represent everything of value owned by the business. So there is a current asset can be cash or anything that can be convertible within a year. And the fixed asset is tangible like a house or a warehouse or machineries that takes more than 1 year to convert it to a cash. Then this the positive side. The other side of the balance is the liabilities represent of anything that you own or you have to pay for the creditors. Current liabilities is anything that you need to pay within 1 year, and a long-term liabilities is anything that you have to pay within more than 1 year. What's remaining between asset minus liabilities, it's if it's positive, then it's owner equity, and it's negative is also owner's equity. And it is owner equity is the excess of all assets over all liabilities. So you do a calculation of all assets, short-term asset, long-term asset, and you do all the calculation of liabilities and subtract from each other. What's remaining there, it becomes the owner equities. In owner equity represent the net worth of the business, and also any profit is included in the net worth is retained as an earning. So the earning, it might be then you can, pay the dividends, or you just invest more and move it to the asset part and liability part of it. So this is how you balance is assets minus liabilities equal with the owner equity, or asset equal with a liability plus the owner's equity. Now, one of the techniques that you want to do is you need to see the break even. At what time, how many products that I have to sell in order to do a break even. Break even will help you to understand when you're supposed to start making profit and when you're supposed to do any expenses. Now, the break even formula is here, as basically talks about the fact that total fixed cost, sales price minus the variable cost. Variable cost per unit, and it's maybe if it depends on how many units, these are the costs is involved. Like when you are in a restaurant, the variable cost probably the food, because the more you produce more units of food, the more variable cost is there. And there is a certain level where it's going to come higher variable cost. But overall, the variable cost is dependent on how many units you produce. The fixed cost is whether you shut off or you have it running, it is there. The cost is going on there, like the rent, like having, equipment there. They're considered to be, whether you are doing the business or not, is a fixed cost. A weakness in determining whether a cost is a fixed or variable. If a firm produces more than one product, then you allocate the variable cost of each product to them to make the calculation of the break even. Adjust the variable cost such as price to see the impact on the break even and the level of the profit and how much profit you need to make in order to reach to break even. So you can play with these, variable cost and the selling price, and you find out how many units you need to do in order to break even. So the performance sources and an application of funds. The performance sources and application of fund statement shows the dispositions of the earnings from the operation and other financing. So its purpose is to show how net income and financing were used, increase the asset and pay off the debt. So the reason is you need to show whether your net income has been increased, and whether it's a finance, whether there is a debt, owner's equity being increased. It's very important for the investors to look at it. It is often difficult to understand how the net income for the year was disposed of. It doesn't matter. The typical source of funds are from operation, new investment, long-term borrowing, and sales of assets. So usually you have the funds coming in from operation, from selling, or from people having a new investment investing, or you borrowing from a bank, or you just make sales of your assets. And major use of or application of fund is to increase assets. You use your money or cash that you have is first to increase the asset by short-term asset or long-term assets, whether you want to buy more stoves or you rent a bigger place, or you want to pay the debt, long-term debt, or you want to pay the dividends to the owners. And this is how you use the fund. The statement will emphasize on relationship of all these items working capital. So if somebody asks you why for example, the funds, the cash in the bank, it went down, it's very clear. You can look at the pro forma invoicement and you say, okay, pro forma balance sheet, and then you say, okay, I paid for the dividends, or I bought a new machineries, something like that. So this will give you a very clear picture of how the business is going on, whether you're making a profit, or you need to put more effort in making a profit, or you just call it a quit. So there is different softwares who do this kind of work. The simplest one is a QuickBook. There used to be something called Simply, ACPAC. You can do it on a Microsoft Excel. Use the spreadsheet if you start a small business. So there are several financial software, as we said. Spreadsheet, you can use always the spreadsheet easily to do that. Now, in the startup stage, when the venture is a small and resources are limited, software should be simple and easy to use. Most allow, softwares, or it could be online. You pay $9 or $10 a month. They can do simple stuff like check writing. You can do the payroll, invoicing, inventory management. You can pay bills with it, utilizing it, paying bills, and you can do a credit management, and you can do the income tax. You will see lots of advertisement on a QuickBook. QuickBook is one of the applications that you can, have it on the cloud, or you can use it as a, download application and do your QuickBook, which is you can do the taxes, credit management, invoicing, all these simple early stage for an entrepreneur to start her or his business. Now, The second part that I would like to talk about it is the fact that we need to talk the source of the capital. How are you going to get your money? Where are you going to get your money now? Well, now we spoke about how you put your home in order, put your stuff in order to get this capital, to get the investors willing to invest to you. But where you can get these investors to fund your capital, your venture. And it's basically um, you need to do a debit or equity financing. What it means is evaluate financing from perspective of debit versus equity. How much do I have, how much I own versus how much I have that I can pay off just in case if I'm in, I need to pay it. And then whether the internal and or external fund. So you need to borrow money or you need to finance your business from whatever from any source. You need to also look at the equity that you have and how you're going to get it. Are you going to use it internal funds or the external fund? And debit finance involve always involved in the interest bearing loan. Now, so if you borrow from your parents, might be interest free, but with the when you borrow from a bank or an investor who they really not don't want to share in your business, they are comes with the interest. With the so debit financing involve the interest bearing loan with the payment indirectly related to the sales and profit. Uh, Requires collaterals. So we in the early classes we spoke about a lot about collaterals. Banks will need to look at your collaterals, things that you have just in case if you don't make a payment, they can take over and sell it and get their money. So there is a short-term financing provides working capital, and there is a long-term debt may be used to purchase an asset using the asset as a collateral. So if you need to buy a machinery, which is it's gonna for a stove that will last more over 1 year, that's called an asset, long-term assets, and it is part of the collaterals. Your house could be a part of the collateral, the car, all these that they will look at them. So it's called what you called a leveraging the firm. The more leverage equal more risk. In a way, the more you borrow money for you doing your business, the more you are risking your business. So if you don't have collaterals, if you're not using your cash, the more you risk. And the problem comes in, and you lose your freedom and you work a way that the investor wants you to work in order for them to make the money. So the equity financing requires no collateral and offers some form of ownership. The investors share in the profit. There is two ways, as we said, when you go and borrow from a bank, they need to look at you, whether you have a house, you have a car. There is a few 5Cs there. They're going to look at it. And if you cannot borrow money or you don't want to borrow money from the bank, you tell an investors that you're going to give him a percentage and he's going to invest with the intention of shares, investor shares in the profit. But the key factor in choosing include availability of funds, assets of the venture, and the interest rate. So you have an option, as we said, by borrowing money from a bank or taking the money and giving share to investors. You need to look at if there is interest rate or there is no interest rate to really to do the investment, or having to borrow the money from or giving a share to, and you need to look at these two things. Now, the question comes in, the second question comes in, whether I'm going to do an internal fund or an external fund. As we said, most of the entrepreneurs, they look at it as how they can collect an external fund, but the investor will look at the other side, says how much he's risking his fund. That will give you more trust as an entrepreneur, that they can see where, well, you're not only seeking my fund to risk, you're seeking even your fund. We're both in the same boat. So the boat is the same, we both sink together. This is how the investor looks at it. As an entrepreneur, mostly they don't look at, they look at more how they have a control over different, assets, which is include the fund. So basically, the trend is like this. In the startup years, the profit are plowed back into the venture. So the more profit you make in the beginning of the years, you put them back into the venture. Assets, whenever possible, should be rented, as I said, and not owned. So you need to want to make sure you lease them, you rent them, so you don't have so much expenses, even if that's help you in the exit policies, or also help you to more be flexible. Um, the other thing that you can do when you're getting things from the supplier, you need to extend the payments from the suppliers and say, well, I'll pay you in the 3 months, and you might be collecting your money from the customer within a month. So there is a 2 months where you have cash, where you can really liquidate them and work with them. Another way of collecting is to want to make sure, as I said, have a quicker and faster ways of money collections, or have a longer terms of making payment to the supplier, because the supplier wants his money. So if you're lucky, instead of paying the supplier in a month, you tell him I pay him in 3 months, and he agrees on it, and you tell the customer I want to collect within a month. So then you have 2 months of period that you can work on it. This is the internal generated or most frequently used ways. The external fund sources, as we said, is the length of the time that funds are available for you. The cost, you need to look at the cost involved in it. So if you are borrowing money from a bank, how much interest rate, and also the terms of the contract involved in, say, borrowing the money, or somebody isn't investing in you, and you need to look at these and evaluate them and see which way you're going to go as an option for yourself. Now, what we type of funds that you're going to look at it is what do you call few and new venture begin without personal funds. It is least expensive in a term of cost and control, because there is no without a personal fund. They are essential, attracting from outside funds, often referred to a blood equity source, include saving, life insurance, or mortgage, or in-house. So few new venture begin once you need least expensive in the terms of cost and control. So how much costs you to get this fund, and whether you have a control or not, you're not having a control. If they are getting from outside, or you're getting it from your funds, or you're getting it from your family, they are totally different control over them. Often referred, it's a blood equity, which is you spend your money that you saved or somebody is saving, and source include your saving, like you said, life insurance, mortgage, selling your house, selling your car, or something like that. The outside investors want a financial commitment. As we said, the percentage of total available assets committed to the venture demonstrate the commitment of level. Now, as I'm an investor and you are an entrepreneur, you come in and says, okay, I need $1 million to do my business. One of the first things I'm going to see is how much you put in your salary for yourself. That's one side. But the most important, I want to see how much you personally invest in it. Because if you're not investing in it, it means that you are not taking risk or you don't believe in the product. The outside influencer wants all available assets committed. Whether you have your own asset or the customer asset, is it should be available for you. Now, um, family and friends provide a small, just give me a second. Okay. Um, so the family and friends provide a small amount of equity funds. The amount may be a small, but it's relatively easy to obtain. And you need to, when you talk about to a family or a friend, you want to make sure that you also treat them as a ownership. Uh, People who put their money in your business, they need a financial statement. They need to know how the business is going on, and the best part of it, you need to treat them as somebody outside investor. Now, maybe it's easier to get funds from them, but it's much, you need to treat them as a investors. uh, to avoid problem, present the positive and negative aspect and nature of risk investment. Keep the positive and the negative aspect and the nature of risk of the investment. You need to keep the arrangement strictly business. As I said, you need to put it always in a writing, and whether it's family or friends, they like to see it in a writing. Any loan should be specify interest rate and payment schedules. So if you're borrowing, whether you're going to pay them as an interest or you're going to give them a share, but if you pay them as an interest on there, you have to also specify the schedule of payment when you're going to pay. And as I said, family members and friends investing in the venture should receive a regular financial statement. Just because they are family or friend, you cannot ignore that part of it. and you need to carefully consider the impact before you're accepting a fund. So if you're taking somebody's fund, you need to look at whether is, you know, the fund that you are utilizing, it is, you know, it's going to affect your business. So these are the things that you need to look at it. And when you decide to talk to, there in the early, we spoke about family or friends, how you borrow the money from them. Now you need to talk about if we're going to go with the commercial banks. The commercial bank usually, they will look at your, when the collaterals is available, bank can provide you short-term funds for it. So you can start talking to your banker, and the banker, the first thing he's looking at is your collaterals. Collateral can be business assets, personal assets, and cosigners. Um, the asset best for loan is usually account receivable, inventory, equipment, and real estate. Um, so the bank will examine your account receivable, or what kind of inventory you have, and whether you have a house or a place that you are doing the business that they can do. Then the bank can finance up to 80% of the value of account receivable. That's in the USA. It's also is mostly applicable here. Use a factoring agreement. Finishing good inventories can be financed up to 50% of its value, and some retailers, such as auto dealers, use a trust receipts. Equipment loans are for 3 to 5 years. When you buy an equipment, they can finance it for 3 to 5 years, and you have to pay for that. Real estate loans are easily obtained because you have a real estate, so they can easily put a cost on them, the price on them, and they can give you 75% of it. This is a standard in the bank is utilized. Now, the cash flow financing, um, here's when we said, when you do your performance statement, you need to look at cash inflow and cash outflow. But sometimes you run short in the cash, so you do a cash flow financing or conventional bank loan. Usually, they will give you, you can run 50% or 5,000 or $10,000, and then you pay them later on. So it's a line of credit, and most of the ventures use it. And bank usually take a fees for it when you request. Installment loan are possible with the previous sales and profit. So you can say when they will ask you for installment loan, and it can be done through your sales and your profit. And a straight commercial loan or advance for 30 to 90 days used for seasonal financing. So if you have that season there is a booming or a low season, you can talk to the bank and they can finance it for 30 to 90 days. The long terms, usually up to 10 years, is are for a strong, mature companies. Usually, a bank don't give 10 years loan unless you have a strong and mature company, or you have a collateral that they can take over. Where there is no business asset, a character loan is an option. So the bank behind, if there is no asset, they will look at your business plan, they look at the chance of the business that's going to happen, and it might be one of the options that they might go for it. and give you a grant you the loan. Now, bank lending decision. Usually the bank, as I said, looks at 5 C's: the character, the capacity, the capital, the collaterals, and the condition. The bank are very cautious in lending money for a new ventures. Usually they don't finance the new ventures. Loan officers and loan committees review the work, but there is an organization who do that. Um, Unless you go to a bank and you say, I'm going to do a new venture and here is my house, or I have a land, and they can take, hold on to you're not able to sell the land until, make the payments. Um, so the loan application format generate a mini business plan. When you're asking for a loan from a bank, once again, you have to do a mini business plan, because they need information of how the venture will repay the loan. They want to see how you're going to pay them back with a satisfactory interest and terms. Um, they also want to see, you know, you need to look at the fact that a bank will give you the money and they need an interest. And when can you have to calculate the interest plus they will give you this information and see how much you're gonna repay that. Because if you have to pay 25% interest on your loan, and you're making a profit of 10% on your products yearly, then you cannot really meet the requirement. You will see lots of countries right now, they're going through a bankruptcy because they borrowed money and they cannot even pay the interest. Forget the main loan itself. So you need to take into consideration that if you have to do the interest plus the loan itself. Now, as we said, um, you know, most of the time, places like banks will be very conservative to pay to lend you for the new venture, unless you have a strong characteristics and you have a good business plan and you have a collateral. They might be giving. But there is organizations available within Canada, for example. And so it's in the state. In the state, there is a small business administration, and you need to dig in to look at these non-profit or profit organization, which is, or they can lend you the money that you are looking for. Now, quickly in USA, for example, something called the guarantee 85% or 150,000. There is similar things in Canada also. Small business administration organization can give you these kind of money, cash, to start the business with you, for you. But for you to find out where they do that, as we said, there is a quite few organizations that you can dig in and borrow the loan for a venture or for exporting. I think there's a business development bank. They help in the exporting. They might give you the loan, or they might give you, it's called the BDO, I think, might help you in exporting, guaranteeing your income. The profit, the money from sales. So here is another way of looking at it. And when you are involved in the research and development for a product, there is more options to work on it. It's between a company that partnership is a kind of a typical R&D partnership. It's between the company who's developing the technology and funded by a limited partnership investor. So the investor comes in and says, I will fund your R&D, and there is rules written for it where we will talk about it on the next slide. Research and development limited partnership are good when the project involves a high degree of research, of risk and significant expenses. So if you're doing a research and development, if somebody is willing to invest, it's good because if it's a high risk and needs lots of spending. Three major components are in the contract: the sponsoring company and limited to a partnership. The contract specifies the agreement. The limited partner have limited liabilities and tax benefit of losses. The early stage are passed to the partner. So once the investors is investing, a company is investing in you, they might be taking that investment that they invested in you and claim a loss. So it's good for their taxes. And sponsoring company act as a general partner. They can be your partner or they can be as a lender. Now, when you do R&D limited partnership procedures, in the funding stage, a contract is established and money invested. The actual research is performed in the developing stage. So when you're doing a research, R&D is in a process of doing in development. If the technology is successfully developed, the exit stage begins. So when the product is ready, the exit from this part of the business it begins. And it's typically the equity of partnership sponsoring, the sponsoring company, a limited partner from the new jointly owned. An alternative is to incorporate R&D partnership. A third exit strategy with the royalties, and the fourth is companies limited to partner. In a way, when you done with the R&D, it says there is an option that you can say you can give a loyalty for investors, you can give them a partnership for the investors, or you can create a joint venture and a new manufacturing company with the investors. So the benefit and cost of the R&D is limited as a partnership is the fact that provide needed funds, that you need to some funds and they can provide you minimum equity. You don't lose, there's not much risk in it. It gives you strength in financial statement of sponsoring company. So this company is sponsoring me, it gives you more strength. And also for them is also they're investing, so they can, if there is a loss, they can really call for, loss in their income tax. Now, the negative part of it is require considerable time and money. Usually it takes 6 months to do such a partnership, and it takes around $50,000 in the professional fees in USA. Not very far in Canada also. Most of R&D usually fails. Therefore, you will find there are lots of limited partnership. People are willing to invest in you, but they will give you a very limitation in it. Restrictions and okay. I will, maybe this is the last few slides and then I'm open for any suggestions. Um, Restriction placed on technology may be substantial. As we said, there is government and it's grants, and Canadian government has lots of grant to help you to set up your business, especially if you're doing a local, helping the local to export. You can get up to $10,000 a grant, sometimes $750,000. Lots of big companies do they get lots of grant because of they having a department of R&Ds. Um, there's a private financing, private investors, or something called angels, and they are looking for to invest. You can find them on, if you do a search, there would be people who is willing to invest, but they have their own, each one has its own different conditions on it. Um, so these sophisticated investors still need access to material information. So they're not going to give you the money. They need a business plan as we're going to do it in the assignment. Uh, the last slide is going to talk about, we're talking about the bootstrap financing. The outside capital has many costs. It takes time when a company can least afford it. People take time to give you the money, so by the time it's too late, maybe it decreases the drive for a profit and puts lots of pressures. It can decrease the company flexibility and start the financiers involved in your work. Emphasize on the short term can be expense. On short term, you might be happy, but in the long term, you might be running into lots of troubles. And bootstrapping finance involves using any possible method for obtaining and conserving the cash. Can involve in delay, as we said, payment. You can make the payment delays and you can get the cash faster. The only possible limitation of bootstrap financing is the magnitude, is the imagination of the entrepreneur. So if the entrepreneur really thinks he can make a profit and make a big profit, he can do a good presentation, do a good presentation plan. This is where you can really go for a good payment. Now, I'm open for your any questions.